Friday, February 13th, 2026, 3:59 p.m. Eastern, silver crashes to $76. Retail investors panic, liquidating everything they bought at $80, $82. But in the final 60 seconds, something unusual happens. Institutional volume explodes. Someone with serious capital went all in, while everyone else was selling. Now, Sunday night futures reopen in hours. What do they know that you don't? Welcome back to your OG, John AG. If you've been watching markets long enough to remember when a dollar actually bought something, when handshake deals meant more than contracts, then you know why you're here. This isn't entertainment. This is your weekly economic intelligence briefing. Now, if you find value in getting the analysis they won't show you on Bloomberg, click that subscribe button, the same way you'd bookmark a page worth returning to, and drop a comment below. Where in the world are you watching from? New York, London, Singapore, or somewhere they're not telling the truth about what's really happening to your currency? Let's begin. Friday, February 13th, 2026. The closing bell rang at exactly 4 p.m. Eastern, and by the time most investors checked their portfolios that evening, silver had closed at $76 per ounce, down nearly $6 from where it traded just 2 days earlier. For anyone who bought silver at $80 or $82 during the week, the screen showed nothing but red. And that is exactly what the retail crowd saw, losses. But there was another story happening beneath the surface, one that most people never see, because they are not looking at the right data. The average investor looks at the price, sees it falling, and makes a decision based on fear. He sells, she liquidates, they panic. This is human nature, and the market knows it. But the professional traders, the institutional desks, the people managing hundreds of millions of dollars, they look at something different. They look at the order flow. Order flow is the actual record of who is buying and who is selling, and in what quantities. It shows the footprints, the evidence of where big money is moving. And on Friday afternoon, those footprints were everywhere. Let's examine what actually happened in the final hour of trading. From 3 p.m. to 3:30 p.m., the pattern was predictable. Retail investors were selling, liquidating positions they bought earlier in the week. The volume was steady. Nothing unusual, just normal fear-based selling. Silver dropped from $77.50 to $76.80 during this period. Then something changed. Between 3:30 p.m. and 3:45 p.m., the volume started increasing, not slowly, but sharply. The price continued falling, down to $76.20. But the volume, the actual number of contracts being traded, was now triple the average. Someone was absorbing everything the retail crowd was selling. And they were doing it quietly, methodically, without pushing the price up. This is what professionals call accumulation. When smart money buys, they do not want to advertise it. They want the price low so they can acquire more. Then came the final 15 minutes, 3:45 p.m. to 4 p.m. This is where the evidence becomes undeniable. Silver dropped to $76, its lowest point of the day. Retail panic reached its peak. Everyone who bought at higher prices was now convinced they made a mistake. The news headlines were already written. Silver crashes on Russia concerns. But the volume in those final 15 minutes was absolutely extraordinary. Over 18,000 futures contracts traded hands. For context, the average for that time period is usually around 4,000 contracts. This was not normal selling. This was absorption on a massive scale. Someone, or more likely, several large institutions, were buying everything available. The COMEX data shows it clearly. While the price fell 80 cents in the final minutes, the buy orders were relentless. These were not small retail orders. 5 contracts here, 10 contracts there. These were institutional blocks, 500 contracts. 1,000 contracts in single prints, the kind of size that only appears when serious capital is being deployed. Now, here is what makes this significant. In market history, this pattern has appeared before major price reversals. When institutions accumulate during retail panic, especially into a weekend close, it signals something important. They know something is coming, or they believe the current price represents a significant opportunity. Either way, they are willing to commit substantial capital right before the market closes for 60 hours. Think about that timing. Why would sophisticated traders, people who have access to more information than the average investor, deploy millions of dollars into silver at 3:59 p.m. on a Friday? Why not wait until Monday? Why not see what happens over the weekend? Because waiting has a cost. If news breaks over the weekend, if geopolitical events escalate, if currency markets react, the futures market reopens Sunday evening at 6 p.m. Eastern, and when it reopens, the price might not be $76 anymore. It could gap higher, significantly higher, and by Monday morning, when regular investors wake up and check their screens, the opportunity will already be gone. This is the reality of information asymmetry. The institutions that bought Friday afternoon, they are not gambling. They are positioning based on analysis, based on data, based on probabilities that retail investors do not have access to. The Friday close was not just another down day. It was a setup. And the people with the most money just showed their hand. The question now is, what happens when the market reopens? There's a room in Lower Manhattan that most people will never see. No cameras allowed, no phones, no recordings. It sits on the 47th floor of a building where the world's largest asset managers make decisions that move trillions. And in that room, every Monday morning at 7 a.m. before the markets open, a group of portfolio managers reviews a single document. It is not a stock report. It is not a technical chart. It is called the Currency Degradation Index. And what it shows is why those institutions bought silver at $76 on Friday afternoon. Because they are not reacting to price. They are reacting to something far more dangerous. The systematic destruction of fiat currency purchasing power. Let's talk about what most financial media refuses to discuss openly. The United States dollar, the world's reserve currency, is losing its value at an accelerating rate. Not because of conspiracy, but because of mathematics. In 2021, the Federal Reserve printed more money in 8 months than existed in the entire economy in 2008. They called it quantitative easing. They said it was temporary. They promised inflation would remain under control. By 2022, inflation hit 9.1%, the highest in 40 years. Then came the denials. Inflation is transitory, they said. By 2023, regional banks started collapsing. Silicon Valley Bank, Signature Bank, First Republic, all gone in a matter of weeks. The government stepped in, guaranteed deposits, printed more money to cover the losses. By 2024, the Federal Reserve was forced to raise interest rates to 5.5%, trying to control the inflation they created. But higher rates created a new problem. The United States government, which owes $35 trillion, now had to pay significantly more in interest every single month, billions more leaving the Treasury, just to service the debt. So what did they do? They printed more money to pay the interest on the money they already printed. This is not sustainable. And the people managing institutional capital, they know it. They see the pattern because they have studied every currency collapse in history. Weimar Germany in 1923, Zimbabwe in 2008, Venezuela in 2016, Argentina. Repeatedly. The pattern is always the same. First, the government spends more than it collects. Then, it borrows to cover the difference. Then, it prints money to pay the interest on what it borrowed. Then, prices start rising. Then, the central bank raises rates to stop the price increases. Then, and the economy slows because borrowing becomes expensive. Then, the government panics and prints more money to stimulate growth. And the cycle accelerates, faster and faster, until the currency loses credibility. Now, look at where things stand in February 2026. The Federal Reserve balance sheet is still above $8 trillion wars. Federal debt has crossed $36 trillion. Annual interest payments on that debt now exceed $1.2 trillion per year. That is more than the United States spends on defense, more than Medicare. It is the fastest growing line item in the federal budget. And there is no way to pay it, except by printing more dollars. Meanwhile, something else is happening quietly in the background. Central banks around the world, the ones that hold dollars as reserves, are diversifying. China, Russia, India, Saudi Arabia, Brazil. They're buying gold, buying silver, reducing dollar holdings, not because they hate America, but because they are protecting themselves. When the Chinese central bank buys 50 tons of gold in a single month, they are making a statement. They are saying, we do not trust the dollar's long-term stability. And if central banks do not trust it, why should institutional investors? This is the context that matters. This is why silver at $76 looks cheap to people who understand monetary history. Because they are not measuring silver in dollars. They are measuring dollars in silver. And by that metric, the dollar is collapsing. In 2020, 1 ounce of silver cost $18. Today, it costs $76. That is not because silver became more valuable. It is because dollars became less valuable. Each dollar buys less silver, less food, less energy, less housing, less everything. The institutions that bought on Friday, they're not speculating on silver going up. They're hedging against the dollar going down. And every piece of economic data confirms their thesis. M2 money supply still expanding. Real inflation running far higher than official CPI numbers. wage growth not keeping pace with actual price increases, savings rates collapsing as people struggle to afford basics, credit card debt hitting all-time records. This is not a healthy economy. This is an economy running on borrowed time and printed money. And when that reality finally breaks through the narrative, when the market reprices assets based on currency degradation instead of nominal growth, silver at $76 will look like the bargain of the decade. The institutions know this. That is why they bought. March 14th, 2025. A commodity trader in Chicago woke up at 5:30 a.m. on a Saturday morning. Not because he wanted to, but because his phone would not stop buzzing, text messages, voicemails, alerts, all saying the same thing. Silver just gapped up $11 in overnight trading. By the time U.S. markets opened Monday, silver had moved from $68 to $84 in less than 60 hours, and he had sold his entire position the Friday before at $67. Convinced the correction would continue, convinced he would buy back cheaper on Monday, he was not alone. Thousands of retail traders made the same decision that Friday. They sold into weekend uncertainty, and when the market reopened, they watched in horror as the price exploded higher. What caused the gap? Shanghai announced unexpected supply chain disruptions, Chinese manufacturing lockdowns, industrial silver demand projected to surge. But here is what most people missed. The gap was not caused by the news. The news was just the trigger. The gap happened because of what was built up before the news. The pattern was already there, and professionals who study market structure saw it coming. Let's examine how these violent moves actually develop. Because they do not appear randomly, they follow a pattern, a sequence that repeats throughout market history. Step 1, a sharp sell-off triggers retail panic. Investors who bought at higher prices see losses mounting. Fear takes over. They liquidate positions. The price drops quickly, convincingly, creating the illusion of a trend reversal. Step 2, volume increases dramatically during the decline. But not all volume is the same. Retail sells in small blocks, 10 contracts, 25 contracts, emotional and scattered. Institutions buy in large blocks, 500 contracts, 1,000 contracts, systematic and deliberate. The price keeps falling, but the accumulation accelerates. Step 3, the sell-off happens on a Thursday or Friday. This is critical because it sets up a weekend gap scenario. Markets close, leaving a 60-hour window for news to develop, and during that window, institutional positions are locked in. They cannot be easily adjusted. Step 4, news breaks over the weekend, sometimes geopolitical, sometimes economic, sometimes completely unexpected. The news creates urgency, and when futures markets reopen Sunday evening, the imbalance is severe. Too many buyers, not enough sellers. Step 5, the gap. Futures open significantly higher than Friday's close. Retail traders who sold now face a decision. Buy back at a loss, or wait and hope the gap fills. But the gap rarely fills immediately, because the institutions that accumulated on Friday are not selling. They are holding, waiting for the move to extend. This exact pattern played out in March 2025, but it is not unique to that event. The same structure appeared in November 2008, when gold gapped $60 after Lehman Brothers collapsed. August 2011, when silver jumped $4 overnight following the U.S. debt downgrade. March 2020, when precious metals reversed violently after the Fed announced unlimited QE. January 2024, when geopolitical tensions in the Middle East triggered a $7 gap in gold every single time. The setup was similar. A Friday sell-off, institutional accumulation, weekend news catalyst, Monday gap. Now look at where things stand today. Friday, February 13th, 2026. Silver sells off to $76, down $6 from the weekly high. Retail investors liquidate in panic. Institutional volume explodes in the final hour of trading. Over 18,000 contracts absorbed between 3:45 p.m. and 4:00 p.m. Markets close for the weekend, leaving a 60-hour window for events to develop. The pattern is identical, but there is another element that makes this setup even more dangerous: the short interest. Futures market data shows significant short positions established between $78 and $82. These are traders betting silver will fall further. They sold contracts they do not own, planning to buy them back cheaper. But if silver gaps higher instead of falling, those short positions become forced buyers because they have to cover, regardless of price. This creates what is called a short squeeze, where the buying pressure from forced covering pushes prices even higher, which triggers more short covering, which pushes prices higher still. It becomes a feedback loop, and the moves can be violent, fast, and unforgiving. March 2025 was a short squeeze. The initial gap from $68 to $79 happened overnight. But the move did not stop there. As shorts scrambled to cover, Silver reached $91 within 5 trading days. Anyone who sold on that Friday missed a 34% move. And when they finally bought back, if they bought back, it was at a catastrophic loss. This is what separates professionals from amateurs. Professionals understand that the highest risk moment is not during the decline, it is right before the reversal. Because that is when emotion is strongest, when fear convinces people to abandon positions just before the move they were waiting for. The current setup carries all the markers. Friday sell-off, check. Institutional accumulation, check. Weekend gap window, check. Short interest buildup, check. Macroeconomic catalysts, check. News flow potential, check. The only missing piece is the trigger, and that could come from anywhere. A geopolitical development, a central bank announcement, an unexpected economic report, or nothing at all. Sometimes the market just decides it is time to move, and when it does, the gap will be ruthless. There's a question every trader asks himself at some point. What if I'm wrong? It is a good question, but there's a better one. What does being wrong actually cost me? Because in markets, the price of being wrong is not always the same. Sometimes being wrong costs 5%, sometimes it costs everything. And understanding that difference is what separates survival from devastation. Let's walk through the decision that thousands of investors are facing right now. It is Sunday evening, February 15th, 2026. Futures markets reopen in 3 hours. Silver closed Friday at $76. An investor sits at his desk, staring at his account. He owns 100 ounces of silver, purchased at an average price of $79. He is currently down $300. Not a catastrophic loss, but uncomfortable. Over the weekend, he has read the news. Russia might dump reserves. Analysts predict further declines. Technical charts look bearish. He is now faced with a choice. Option 1, sell when the market opens, take the $300 loss, and move on. Option 2, hold the position and see what Monday brings. Which decision carries more risk? Most people would say holding carries more risk because the price could fall further, the loss could grow. But let's examine what each scenario actually means. If he sells at $76 and silver continues falling to $72, he saved himself $400 in additional losses. He made the right call. He protected capital. But if he sells at $76 and silver gaps to $85 on Monday morning, he locked in a $300 loss and now watches silver rally without him. If he wants back in, he has to buy at $85, which is $6 higher than where he originally bought. So his $300 loss just became a $900 opportunity cost. This is the asymmetry that destroys retail traders. They focus on avoiding small losses and miss massive gains. Now let's look at the alternative scenario. If he holds at $76 and silver falls to $72, his $300 loss becomes a $700 loss. Painful, absolutely, but still manageable. Still recoverable if silver eventually rebounds. However, if he holds at $76 and silver gaps to $85, his $300 loss becomes a $600 gain overnight. And if the move extends to $90, like March 2025, his position is now up well on $100. Same decision, wildly different outcomes. So which risk is greater? The risk of losing an additional $400 or the risk of missing a $100 gain? Professional traders think in probabilities, not certainties. They ask, what is the probability of each outcome, and what is the magnitude if it happens? Let's assign rough estimates based on historical patterns. Probability silver falls further to $72, perhaps 35%. Probability silver stays range-bound between $74, $78, perhaps 30%. Probability silver gaps higher to 85 plus, perhaps 35%. Now calculate expected value. Downside scenario, 35% chance of losing $400 equals expected loss of $140. Upside scenario, 35% chance of gaining $100 equals expected gain of $385. The math favors holding. But here's what most investors miss. The probabilities are not static. They shift based on what happened Friday afternoon. Remember the institutional accumulation, the 18,000 contracts absorbed in the final hour. That changes the probability distribution. Because when smart money positions heavily on one side, the odds shift, not guaranteed, but shifted, so the real probability of a gap up might be closer to 50% or even 60%, which means the expected value of holding increases dramatically. This is how professionals think. They do not eliminate risk. They manage it. They position where the risk reward is favorable, and they size accordingly. If an investor is terrified of silver falling to $72, he should not be holding 100 ounces. He should hold 30 ounces or 50 ounces, an amount where even the worst case is tolerable. But abandoning the position entirely right before a potential gap, that is not risk management, that is fear management. And fear is the most expensive emotion in markets. Now let's talk about Monday morning when markets actually open, because the first 30 minutes of trading will reveal everything. If silver opens at $76.50, barely changed, and volume is light, that suggests the gap scenario is off the table and patience is required. If silver opens at $78, up modestly on moderate volume, that suggests slow accumulation, a grind higher, not an explosive move. But if silver opens at $83, $85 or higher on massive volume, that is the gap, that is the squeeze, that is what Friday's accumulation was positioning for. And at that point, the decision has already been made. Those who sold are watching from the sidelines. Those who held are deciding whether to take profits or let it run. The professionals who bought at $76 on Friday, they already have their plan. They know their exit points. They know their risk limits. They have already calculated scenarios. They are not reacting emotionally. They're executing a strategy. This is the difference. Retail investors make decisions based on current pain. Professionals make decisions based on probable outcomes. And over time, that difference compounds into vastly different results. So here's the framework. If you believe the macroeconomic forces discussed in part 2 are real, if you recognize the pattern from part 3 is valid, if you understand the institutional accumulation from part 1 was significant, then holding through uncertainty becomes the logical choice, not because it is guaranteed to work, but because the cost of being wrong by holding is smaller than the cost of being wrong by selling. And in markets, minimizing the cost of being wrong is often more important than maximizing the probability of being right. The futures market opens in less than 3 hours. By tomorrow morning, everyone will know if Friday was a trap or a setup. The institutions that bought at $76 already made their bet. The question is, did you